Greetings and welcome everyone. Thank you for joining us today to discuss Intellect Design Arena Ltd financial results for the fourth quarter and the full year of fiscal year 2021-22 ending 31st March 2022. The investor presentation and the press release has been sent to all of you and is also available on our website. Our leadership team is present on this call to discuss the result. We have with us today Mr. Arun Jain, Chairman and Managing Director, Mr. Prabal Basu Roy, Advisor to the Chairman and Director on the Corporate Board, Mr. Manish Makhan, CEO of iGTB, Mr. Rajesh Saxena, CEO of iGCB, Mr. Banesh Prabhu, CEO of Intellect Seek, Mr. T.V. Sinha, CEO of IRTN, Mr. Venkat Sarnu, CFO, and Mr. Andrew England, full-time director. Besides, there are some other senior members of the Intellect management team who are also present in the call. Mr. Arun Jain will brief you on the result, and this would be followed by Q&A. This would be replied by the senior members of our management team.
Thank you, Praveen. Good afternoon, everybody, and good evening. It's a great pleasure for me to announce the result. I think we performed very well during this year of crossing 25% growth. We initially designed the growth for 20% and we finally achieved 25% of the revenue growth. Our PAT growth comes to 33%. So cash collection is all-time high and our cash balance is all-time high of 558 crore. So all the financial metrics is good. Our market presence is good. The kind of deals we are winning is good. Our acceptance and investment, early investment which we made in a cloud technology, those are coming out, those are delivering great results to us. We have a cloud revenue growth of over 112% during the year. So I will just summarize my points. As presentation deck is there. We talk about it that we accelerate digital transformation journey where maximum amount of dollars are spent in the industry. So I'll say there are 7 elements which went very well in this quarter. Annually, I said it is a fantastic year for all of us at Intellect. It's giving a great expectation for going forward to all of us. So first of all, the cloud, when we say 4 exponential technology, 5 platform, 12 products, that's our whole asset base. It used to be 4 platform when I talked to you during the technology day in December. We added one more platform which went live. This is a trade and supply chain finance technology upgrade platform. This is a platform normally sitting on legacy platform. One of the large deals which we announced 2 years back in Singapore was around this platform. Now this platform has been launched on a cloud, which makes it 5 platforms. So the cloud growth of 112%, or if I look at it, annualized growth of this quarter of close to 119 crore, tantamount to $60 million of a run rate cloud business, which is achieved in just 3 years of our entry into the cloud space. And organically $60 million to be achieved in cloud business is a phenomenal success to Intellect and management teams, Manish, Rajesh, everybody who contributed in building, or Banesh building this cloud related business. And second milestone is we crossed 1,000 crore of license linked revenue, exactly 1,060 revenue, which is purely coming from license linked revenue. When we started the company, we started with 600 crore as the overall company, and license was close to some 100 crore or 150 crore. In last 6 years, that momentum of the license linked revenue, which was to the limit of something 150 crore to 160 crore license in 2015-16, today that crossed 1,000 crore. I think very few companies can boast of having a license of India sold in global market. And we take a pride this 1,000 crore come from all the top banks in the world. In India, we have 8 out of the 10 banks from RBI, HDFC Bank, ICICI Bank, Yes Bank, IDFC Bank, you name it. I think we have all the banks where we have a deep footprint. It comes from the best banks in UAE. Top 8 out of the 10 UAE banks are our customer. Top 3 banks of Saudi Arabia, top bank of Singapore, top bank of Malaysia, top bank of Philippines, top bank of Indonesia, top bank of Vietnam, top bank of Australia, top bank of, if you move into these geographies, one of the top 3 bank in South Africa, top 3 bank in UK, top 3 bank in France, in Spain, in Germany, in Sweden. I think that's, and then are Canada and US. And that is what make the product company different on the whole trajectory which is there. And that makes the biggest deal which we announced last quarter is Reserve Bank of India. They are interested to give complete cloud native central banking solution first time in the world on managed services to Intellect. It's a big confidence Reserve Bank of India demonstrated in the technologies, and they took almost 18 months to evaluate our internal technology with their architect that is suitable for next 10 years or next 20 years, this technology is suitable or not. This contract is a 7-year contract, runs into close to over 400 crore. So this contract, we have very least accrual in this quarter for this contract. This contract is a large value contract, but since it is signed in the last and it's being designed to build on a completion based POC basis, completion basis. So obviously, by the time it's signed, we complete only a small portion of the contract, and that's why it's not a full license being booked onto the contract upfront, which is normal practice. But this, since it's a full managed services contract, this we require to bill partial billing, and that has some shortfall from that perspective of the expectation of the investor, that revenue has some shortfall because of that. But that's not an issue at all, because on a long run, it's a full deal, managed services deal for 7 years. We got another very large digital transformation deal for a large private sector bank in India. This is about transforming their entire digital scope for the transaction banking, entire payment systems. And this is another very big deal where client entrusted us and give this deal for execution. The fifth point is our Microsoft partnership. Looking at all the wins what we are getting and the presence we have in the marketplace, banking and financial services division of Microsoft Azure, where they have brought in very senior people from the industry to lead the financial service segment, whether Bill Boyden, who was also coming from transaction banking, or Peter Hasso. They have seen all the companies in the world in transaction banking business, and they've chosen us to be partner on Azure. This will give us a huge access to the customer in Europe and Americas, all the advanced market besides Asia and Middle East. But our sales team will get enhanced and get a better footprint in all the advanced market over there. Besides this, next point is Dbs and Bajaj Finser. They launched their operation in India last month, and they are operating on our card platform. This is a platform which we are building it up over the last over the 3 years period, but it's now moved to the cloud, and DBS has chosen this platform against all the standard platforms they have in Singapore or the global products. So that going live creates a opportunity of credit card area. What has not gone so well in this quarter is Russia-Ukraine war. We lost one large mega deal. It was about core banking transformation for Russian bank. You may guess the bank in Germany. They were already about to sign the deal on the same day where Rajesh was about to fly to sign the deal, and that Russia attacked Ukraine. There was a smaller deal which we are not mentioned in the press release, where we were to implement trade supply chain finance system in Ukraine for one of the European banks. and that was supposed to be implemented in Ukraine. Both these deals, we have not booked any revenue. We have not booked any exposure on the company books. So it's completely risk-free from that perspective. If we would have signed the deal, let's say in January, and then we might have to take a write-off of the deal, that would have been harmful for all the investors. So on one side, it is good from the revenue perspective, but bad from the loss of at least $4 million of the revenue, which could have been accounted in this quarter because of the deal. Second thing is about talent cost. 13 crore cost increase happened during the quarter. Over the last quarter, this 13 crore is attributable to salary increase and employee increase and few travel which started sometime in March. So these three elements constituted the 13 crore increase in the deal. On the front of, we look at six capital, the way we look at the whole business, our technology capital, where our products which I was mentioning is gaining momentum. If you look at technology day presentation, we are progressing very nicely, continuously in that space. In leadership space, our leadership, which is, we call it most critical for product company, which is the top 500 people in the company who has the deep expertise in the product business. Our attrition is less than 10% in that space, which is a very, very good news, because the expertise is, when the industry is running around 25 to 30% attrition, we were able to retain the critical talent in the company, which is very, very useful for us. Our customer base, I mentioned that we have 270 customers at end of the year, and these customers are marquee clients of every geography, and that makes it another area for next years when we look at the journey. Now we need to go deep in each country and expand the each country operations on customer capital. I want to bring to the attention the execution capital. How do we deliver the product to the customer? And there the significant improvement happened, which is displayed by 558 crore cash in the company, is demonstrated by single phenomena in last 2 years, which happened is we applied design thinking for execution excellence. What does it mean? As an investor, I cannot explain the nitty-gritty how we work on. We did a digital transformation of one of the Malaysian banks on cloud. A typical digital transformation takes 18 months to 24 months. Globally, that's the benchmarking of a digital transaction banking. When we go sign the deal, after signing the deal, you have observed the AMC takes 2 years to come in. It's because 18 months is a cycle time for the implementation. For this, using the cloud as a technology and using our delivery methodology, which we call iZoom methodology of implementation, where we break down every small user journey to the smallest work packet to be delivered and what decision customer needs to give it, we are able to implement the entire cycle in 6 months time. So it's a significantly moat we have created for digital transformation using our execution capital when we apply design thinking at a requirement stage, solution stage, engineering stage. So we are inspired by Toyota, but Toyota disrupted the auto industry of Americas in 80s. That's how we are looking at it, Intellect disrupting the IT implementation industry by bringing every smallest component to be so perfect that it accelerates the transformation on a cloud significantly faster. And that's our storyboard for next year. On future side, if I look at next year, our design strategy is 20%, which is stated strategy that we have designed our organization for 20% growth. And we are not looking to downgrade or anything because of the international disturbances are there. We understand international disturbances. We have taken into account those deals and those pipeline deals, which were sitting in those areas which are doubtful. In spite of that, our sales pipeline has grown to $725 million from last quarter, substantially higher than the last quarter. Our destiny deals have gone significantly, are also grown up to 61 destiny deals. So all the metrics which is there for us to see the next year, there was a dilemma in management team, should we look at design of 20%? We designed for 20%. This year we are able to do 25%, which is much better than what we designed the organization. Obviously in product company, which is measured on an annual basis. So first of the principle of product company is that never a quarterly company. It's not a service company. Again, Indian investor believe that everything is a quarter on quarter. And I mentioned multiple times that when you have a deal of 4 million or 5 million in a single deal, it 4 million deal means 30 crore of additional profit or 30 crore of additional reduction in the profits. Now, that is not a way we can understand and play on Intellect stock from that perspective. But 20% move to 25% was our delight as a management team. We are all celebrating that element, that 25% growth we achieved, and next year we are looking 20% growth should be available. Then next thing is Microsoft should accelerate, building some tailwinds to our 20% growth. That should help us out in doing it. We have seen where we have given a focus on the countries. So where what I mentioned, that if you go to the top bank in a country and then expanding the footprint in 2016, I spoke about it, that our strategy is to go to the top, one of the top 3 banks whenever we enter into the country, and then we go down from top 3 bank to the rest of the banks in the country. And that strategy is working in India, that strategy is working in UAE, that strategy is working in UK, that strategy worked in Canada, that strategy is working in US. So these 5 countries where we spent full kit sales team, we invested into these 5 countries. We have achieved substantial runway of more than $30 million revenue per country is delivered by these 5 countries. Now we are looking, choose another 3 countries for market expansion where we deepen. So we have 18 countries where we do a revenue pool of, where we have a $3 to $5 million revenue pool per country. This revenue pool for 3 countries we chosen, one in Asia, one in Middle East Africa, and one in Europe. And these 3 countries will be deepening by putting more, moving the sales team. So we have moved Paramdeep Singh, who was Executive Vice President, to lead our Vietnamese business, and Vietnam will become our focus country for deepening the relationship there, deepening the country there, so that number can move to $10 million per country in a next 2 to 3 years window. What next point which is working in favor of Intellect is, we now learned how to deal with, last time you asked a question, can you crack $50 million deal? Some investor asked a question. And I was, we were working with RBI for that deal, but I was shirking away that question that yes, we are working on those large deals of $50 million. And we demonstrated the $50 million deal we can crack. Because $50 million deal, we need to have a proposal team, the proposal team, pre-sale team. It requires a full village to win a $50 million deal. But once you have all the templates, all the calculations, all the commercial arrangements, all the delivery nuances coming together, the organization moved from $5 million deal to $15 million deal to $50 million deal. So we crossed third hump of $50 million deal. And it's about strategic deal. When we call destiny deal few years back, that we are focusing on a strategic deal, that is what is working well now. And that's how we look at it, that we prepared the organization for saying calibrated $60 million, 2 quarters of $55 million, 2 quarters $60 million, and then you $67 million, and then $75 million. So our focus will be to, in next 2 quarters, to reach whatever the investment we did, initial additional investment last quarter and this quarter for the headcount, that will be prepared for $75 million run rate, and that we are hopeful to achieve faster. But looking at the tailwinds which are available to us, we need to invest higher from the sales and marketing side along with Microsoft. So some increase in the budget will happen. One is because of travel. Obviously, the travel cost will go up. COVID is open up, so all the meetings have started happening. Face-to-face meeting. The beauty of the face-to-face meeting is those large deals which are there internationally, we could able to sign a lot of deals, but now the face-to-face, our sales team is able to influence the deal to earlier closure of those deals. So that will be helpful. So one, investments will be on the sales and marketing side for the coming year. And second side of investment will be on product investment. As of now, in spite of the salary increase, our capitalization of the product is still at 116 crore versus 120 crore. Next year, this budget will go by at least 15 to 20%. The R&D budget will go up because we are looking for those countries where we are entering. We have to make it last 1% suitable for that country, the product upgrade, the technology edge, and the interfaces. So those are the places where the large edge investments are going into next year. Our product like Wealth, which is bought by SBI, is a great validation of wealth products. So those are the high growth product. Underwriting products are taking momentum in US and underwriting products. Treasury product is taking momentum. So these are the third layer of the product besides the top layer of product, liquidity, quantum, and GTB, the three products which is the core leading products, and then IDC, IDL, payments, and cards, which is the next generation products. So it's a very, very healthy pipeline over there. Next year, our tax rate will come to 26% levels. The standard tax rate will be, all our losses are being taken care of. In this quarter, the tax rate has gone up somewhat because we exhausted the cumulative losses which were available for us till third quarter. So fourth quarter tax rate has gone up to slightly over 20%, but regular tax rate will be 26%. But one beauty is on effective cash tax rate or balance sheet tax rate will remain at 17 to 18% because we have a 96 crore of MAT credit available to us. That 96 crore will take at least next 2 years for us to bring our tax rate, effective cash tax rate, above 18% of the tax rate. So this is what I think I wanted to share as a story with you. And at this point of time, I can leave for question and answer. All the presentation slides, all the data slides are available in the deck, and any question arises from there, you can go through it.
Thank you, Arun. Now we are opening the session for Q&A. Please click on raise your hand to ask a question. So we have first question coming up from Mr. Rahul Jain of Daulat Capital. Rahul, you may ask your question, please.
Yeah, hi. Yeah, hi. Thanks for the opportunity. First question is on the growth and the comments you have shared on the cost side of it, the headwind. So I understand that the year has progressed well, but at least from a Q4 exit perspective, we faced a couple of challenges. So how, with these things going into FY23, how some of your overall outlook changes and what are the risks that get assigned to that outlook with the change macro situation?
Rahul, I mentioned to you, we are quite confident on the pipeline what we have, the deals, the pipeline what we have, and those pipeline make us confident that our design growth of 20% is all possible, and if unless something else happens in the industry or anything happens in the industry. As of now, whatever the parameters available to Russia, Ukraine, all the deals, we talk to all the customers and all the pipeline member who are in P4 and P5 stage of our sales funnel. We are quite okay for managing the going process. Yeah, salary cost of the talent is definitely a concern, but that's an industry phenomena. We have a less dependence on headcount increase compared to any other industry. We are not expecting in this quarter not to add more than 100, 125 people in this quarter. So there is not a significant pressure on from additional count, but salary increase is definitely will be which gets distributed over 4 quarters.
And Rahul, to answer your question as well, you know, see, none of us can have ever disregarded the macro factors which are affecting the global economy today. Having said that, the pipeline numbers which you see in the presentation shows a healthy growth, and that is after discounting and clarifying with various customers about the digital transformation journey, allocation of capital, and all of that. The key point here is that while the larger players in the BFSI segment will have issues to some extent, it is our belief that niche focused players, which are especially IP related, will be able to weather the storm relatively better based on current circumstances as we see it. So therefore, as everyone said, the organization is designed for 2020. We see no reason to change that design at the moment.
Right. Just a small follow-up on that. On the profitability side, since we are already at a much higher growth rate than the 20% kind of a thing that we are highlighting as of now. So what should be the margin given that we have headwind plus the growth rate would be lower compared to last fiscal? So is it safer to assume the Q4 should be the benchmark going forward right now for the near term?
Rahul, look at the LTM basis margins. Don't look at it quarterly margins. Quarterly margin is no indicator. If $4 million deal of Russia could have been there, the margin would have been 28%, 29%. So for a product company planning, do use different yardstick on an LTM would be better yardstick for you.
Okay, so 25% for the full year is the right number to look at.
I don't want to put the numbers still full, but my PAT margin will be lower because of tax rate. Effective tax rate on P&L will be lower. So PAT, visible PAT will be lower because 26% will be there, while effective cash rate will be, tax rate would be not more than 18%. So that's how I think you have to make a judgment call.
Right. And to the comment that Prabal made on the macro situation and how some of the large banks may think about the way forward. So is this also emanating from some of our conversation, or this is a generalist view in terms of past cycle behavior that we might have witnessed?
This is general macro issue, not a client talking. So don't mix the two issues. Client he has mentioned, Prabal has mentioned, that client we talk to, we are finding they are looking for this technology faster than the earlier. So the liquidity solution which we have with the interest rate going up, it becomes valuable product because all the banks are now accelerating the journey because all the corporate is putting pressure with the interest rate going up. Liquidity, Manish, you can just throw some light on the liquidity product, why the interest rate increase is helpful for selling the liquidity.
Yeah, that's on a leadership quadrant product for us, and actually you will see on the press release also we have been rated best in class by ITA, and there's a significant gap between us and the next vendors over there. That's from a market positioning perspective. Interest rates, if you look at across the board, I guess including India yesterday was increased, UK was increased today. This is an opportunity for corporates to gain more, and for banks it becomes quite a defensive product as well as a retention product to ensure that the balances remain with them. The amount of RFPs I'm dealing with is at an all-time high right now from a number of European banks as well as Asian banks. So this demand will only grow with all these interest rates. I think UK itself is saying we will expect another 2-3 interest rate hikes. US is saying the same. Across the board in Europe, you're hearing the same thing. So the demand for it will only go up. I think we have established success for very large banks in US also to get them live in 6 to 9 months. You're leveraging our iZoom methodology. That creates that mode for us of having a ready product to be able to implement fast and having market coverage for covering tax regulation for 60 plus countries. No one else has that ready product from a market perspective. Any large global banks will have at least 30 to 50 country footprint. So that becomes a big differentiator.
And also, Manish, if you could share a quick thought on this iColumbus, how it changes our market positioning or TAM or anything.
So if you look at most of my revenue driver was through cash management from a corporate banking perspective. Trade and supply chain, we had done a deal with Raiffeisen Bank before, and then UOB in Asia, in Singapore. That's where we were modernizing the platform, AI-based cloud native infrastructure. It was important to ensure we establish right level of success. And if you look at any of my peers, their trade revenue is higher than their cash revenue. That gives you as a perspective of the revenue pool I will be playing into. So that's a very big opportunity of now taking it out to a market leading product where we've invested and established success, and to take that out to the market. So that should add to the growth of the platform.
Okay, so you're saying this iColumbus is kind of a test deployed already on these the two transactions that you mentioned in the past.
That's where the base formation of that happened over there. We have significantly added AI capabilities and other capabilities which will be taking it out. And this is the only product out in market where you have trade finance, supply chain finance, collateral limits integrated along with a channel which is integrated with a cash channel. No one else has that capability. So now it's about monetizing that, taking it out to market, marketing it that. So that's where we focused on. And if you look at again from a trade perspective and the supply chain perspective, all the demand supply gaps which we are hearing in the market, as well as the pressure on trade to digitize and how AI will help you do that faster and take paper automation. I think all of those things we have addressed looking at the market needs.
Sure. That's quite helpful. Just last one, bookkeeping one. On the other income side, sorry, I missed your comment if you have shared already. What is the reason for the other income jump?
There are two reasons for it. One reason is subsidiary income. So there are two companies, NMS Works and Adrenaline. They delivered a good Q4. So they are not a consistent number. And then there is some reversal of which we considered more than, our auditors consider more than 3 years outstanding as a write-off. There was a write back into it. And treasury income. The third component is treasury income. Now we have surplus cash, so there is a treasury income also.
Thank you. I'll get back into the queue.
Yeah.
Thanks, Rahul. Next, we have Mr. Vivek Charoria. Vivek, please ask your question. Please unmute him.
Hi, sir. Thank you for the opportunity. So we've had 2 quarters where we've hit a run rate of $67 million. Should we expect this to ramp up from the next quarter onwards? And as you alluded earlier, should we expect to hit a run rate of 75 in the next two quarters? And if yes, if we go from 67 to 75, and even if the costs increase, the margin as a percentage should go up. Would that be fair to assume? Thank you.
That's what we are shooting for, that 75 million, where 75 million is next quarter or next to next quarter, but that's what we are shooting for in next 2 quarters. One of the quarters we should hit $75 million. So you understood right, Vivek.
And Vivek, not very far away in history, I think it was you who asked the question or others that we were struggling in the $55 to $60 million category. So we are already talking of a $75 million hump at that stage. I think just keep that in perspective as well.
So just one more question. On the talent front, should we expect a bit more to come in the books, or most of it as of now is on the books, and from here on we should expect regular sell increases? Or do you think, because in the last order you had mentioned that a bulk of the cost was yet to come on the books. So would you say a Q4 run rate of 250 crores, as I can see on the P&L for the employee cost, would that be a fair base, or do you expect this to go up higher than the revenue growth from here on?
It won't be higher than revenue growth, but I think the cost rate will go up, increments and some 100 people additional cost. That's what we have. And now I'm saying if you are making a sales and marketing investments, then those will be the also part of salary cost will come in.
And sir, once we up to what level of revenue can the current capacity sustain? I'm just trying to understand because we've been talking
as
in the
of now,
past.
$75 million. $75 million current capacity is there. That's what we have mentioned to you. And that is what we completed till March 31st. Now next milestone is 100 million or 90 million. That's what we need to see when we are preparing the organization for $100 million, $400 million run rate in next 2 years, 2 to 3 years, whatever the numbers will be there. So that is where our effort will be there. What is the right investment we need to make? That's why 3 countries we've chosen in this year. We want to choose again calibrated growth of the country, 3 countries per year. Then we make a full country and then expand further on it.
So just one last question. As we've been saying in the past that since you're a product company, so I'm guessing as we go from 67 to 75 to 90 to 100, at some point there should be a jump in the margin, right? I mean, because we had mentioned that beyond a certain point, most of it flows down to the Ebitda. So would you say that, I mean, that might have been delayed because of the cost increase, but that premise is still valid?
Premise is fully valid, because if you say license link revenue of 1060 crore this time, that 1060 comes flown into the bottom line without an additional cost of the delivery. So that number is the one important number you have to monitor, is license link revenue. And that, but on other side, some companies stop investing. You have seen some of the product companies stop investing and then push for the margin, like FlexCube may push for the margin to 40%, 45%. We will not be doing that. So we have been advised by the investor, all of you, that we don't push for the margin beyond a point, because market size is too big for us to capture. And for that, we need to constantly keep on investing ahead of time for our growth. Growth investment has to be part and parcel of it. And you have seen multiple product companies which stagnate at 60 million, which stagnate at 70 million, just because they stop investing into growth investments.
Absolutely. And Vivek, you see, this statement which you just made is very crucial to understanding this, which is that most of these companies we compare with, or is being compared with, are essentially single product or dual product companies. Right? We are very young, and they are much more mature companies, number one. And secondly, they were just 1 or 2 product companies. We are 12 products, 5 platforms now, and 4 horizontal technologies, right? So this is our IP chest, so to speak. So as a result, continuous investment is the right way to go for shareholder wealth. I mean, there is no other great mantra to it apart from that. So that continuous investment will form part of our strategy, purely for the reason of our IP richness.
That was very helpful. Thank you.
Okay.
Thanks, Vivek. Next, we have Mr. Nitin Gupta. Please ask your question.
Yeah, my question is like, what are you planning to do with the cash that you are having on your books?
We declared the dividend first year. This is the first time we did the sharing the dividend. But I think cash in the books is just starting to build up, as I mentioned last time. We'll be looking at it where the opportunities are there. We are not a acquisition company, but if some opportunities are there in the market, we'll see if something comes out, but not to disturb the system. Whether it could be market-facing acquisition if it comes in our way, or mostly market-facing, not on a IP side. IP side, we have everything available to us. So if market-facing, which gets us an acceleration somewhere, then we may consider. But otherwise, we'll 2 buckets: pay back to the investors, and then deploy in case of if M&A opportunity comes our way. We need to keep our kitty ready.
Okay, one minor point. So for how many quarters this ESOP cost is going to continue?
What is it?
ESOP
cost will continue.
ESOP will continue, no? ESOP is 4 year. It's every time we issue the new ESOP, so ESOP will be there. As of now, we have it. This quarter, I think we have cost of around 11 crore. 11 crore is this quarter cost. So in this year, we spent something 40 crore in ESOP RSU, which is not a non-cash payment. So 40, so that is bundled into it. If we take that into account, it's around 40 crore will be close to 2.5% of EBITDA margin. Okay.
Thanks, Nitin. Thanks, Nitin. Next, we have Mr. Mayank Babla from Dalal and Barocha. Mayank, you can ask your question.
Hi, am I audible?
Yeah,
Mayank, please go on.
Thanks for taking my question. Sir, just wanted some clarity. Sorry, I missed earlier. We lost two deals, right, because of the Russia-Ukraine crisis. And so you mentioned, I think, $4 million was the size of the deal.
Yeah. That's right.
Of both put together?
Both put together, yeah.
Okay. And so I know it's a bit difficult, but any view on when we can recover or, this deal will be back on track?
Unlikely as of now. Russia in Europe, operation of Russia in Europe will not be activated for next 2-3 years.
Oh, okay. Okay. All right, sir. That's all from my side. Thank you so much.
Thanks, Mayank. Next, we have Mr. Rajiv from Ambika. Mr. Rajiv Parekh from Ambika.
Yeah, hi, this is Dikshit Shah from Ebitda FinTech. Thanks for taking my question. Arun, congratulations on a good set of numbers. My question is, everyone seems to be too focused on 1 quarter EBITDA margin. But my question is on the overall, how do you see the next 3 years? And you have now 5 platforms and you added 1 platform. You already talked about moving to 100 million run rate a quarter from 67 over a period of next 2 or 3 years. But where do you see the company in next 3 years? And how do you see it between GTB, GCB, and insurance?
So from a product company perspective, I would say 5 years is a good horizon. We should look at it, that how we have designed the company for a next 5 year duration. So that's our whole design is all about. When we are invested into cloud technology in 2019 and 20, and we suffered some losses, those are very advanced investments which has delivered the result for our SaaS revenue to go up to $60 million annual run rate. So even if say 50-60 annual run rate, this is a these are recurring revenue streams, and that is license link revenue. So that's, once you look at it, that each time we are selling into one country, like in UAE, if I am selling to the ENBD as a bank, and then I sell to FAB as the next bank, the premium got increased and my delivery time has come down. So my margin has gone up on every deal when I go. As of now, we are building on three products, as you mentioned, 3 out of 12 products, 5 platforms. 5 platforms just started working on it, this 5 platforms. So this is a big scope to us. We are finding our competition is getting slightly off track. Temenos is looking, private equity investors are looking for Temenos. Great news for us. If private equity buys them out, they will squeeze the research R&D dollar out of the window, and that's what is our sweet spot for us. We have seen Finestra going down the tube when their private equity investor has taken the money. So we wish that it should become private quickly, so that they will. So with that, competition get under pressure of doing and cutting the cost and no R&D investment. We are quite bullish about the future, because there are not too many companies which have got this strength. Not too many. We don't see any single company in financial technology space which has got a complete suite of 900 APIs, 300 PBCs, and ability for Compose and Manish IZOOM methodology of 6 months implementation. it's a very, very different space we are looking ourselves. And that's why we want to be calibrating. That's why we don't want to make any single mistake in this journey, which will topple our engine, whether it's a security, whether it's extreme security, the investment in security, the investment in performance of the technologies. So those are things are become very, very critical. So just to answer your question, I think we are building, design thinking is helping us out to building a culture. Culture itself is a moat, a big moat for any competition to come in. Because when I say execution capital, when we do the implementation, Nishid, we talk about work packet level, 4-hour work packet. So we are breaking down like a Toyota work packet on assembly line operation, how each work packet get executed. We are breaking down the implementation into those work packets. We have sheets running into our project planning sheets running into PGM 110 to PGM 120 to PGM 130. And that's how the 6 months implementation can be done for the large banks in Malaysia. And that is very, very different mode. If you can cut down the delivery cycle time by half, I think world is yours.
And the point which he left unstated is that.
Can you speak a little loudly, Prabal?
Yeah, sure.
Hear you.
The point which is left unstated is essentially that what he just mentioned is that we are trying for the first time in the IT industry of essentially doing what Toyota did in the manufacturing setup. We are now trying to do it in the IT industry. So it's really a very, very big fundamental move, and we're able to do it over the next few quarters. You will see the results. As such, results are already evident, but so just keep that in mind. It's a really seismic shift, as and when we come from the IT industry as a whole.
My next question is on the GCB side. I mean, how is the consumer banking space shaping up, and the competition, and how are we winning, and how is the pipeline there?
We just explained all the pipeline. I think we have a good pipeline. We have growth of $725 million pipeline. The Asian deals are growing. Strategic deals are there coming up. So overall, Nishit, it looking to be good.
No, particularly the global consumer banking.
The global consumer banking. Rajesh, you want to comment?
Sure. I think when you look at global consumer banking, there are really 4 product lines that we talk about. One is our IDC proposition, our flagship product, IDC, lending, our leadership product, which is the central banking, quantum central banking, and now the credit card platform. Let me just spend a minute on each of these product lines so that you'll get the granularity on what we are seeing. I think on the central banking, Arun talked about the large deal win that we had on RBI. Besides RBI, we also closed 2 very large deals on central banking. And we had closed 1 deal in the previous year. So we are seeing humongous momentum in the central banking space. And in fact, as a leadership product, we are now seeing us being called, rather than us going to these clients. Clients are calling us and asking us to participate. So central banking, we are seeing good momentum, right? And many central banks are going through this process of modernizing their core banking system. IDC, we are seeing some very good traction in Europe. Our product, unfortunately, Arun talked about one of the banks, the German direct bank, the deal which we lost because it had Russian ownership. The bank had Russian ownership. But we are seeing very good momentum. We are in the last 2 or 3 in many large deals in Europe, and that journey in Europe and other parts continues. Cards, we talked about the recent launch. I think you may not have noticed it, but Bajaj Finser and Dbs came together to launch the first co-branded credit card. This credit card is not only managed by us from a technology perspective, but also from an operations perspective. And the way this platform has been designed, it's a low touch, no touch with a a lot of empowerment from a customer perspective. So customer can do a lot of operations. So it's a game-changing platform that we have put together along with the IP of both Bajaj Finser and Dbs. So we are very hopeful that this platform, which is now gone live in India, we will be able to take it. So from a market perspective, as I go and meet a lot of clients, I see a lot of opportunity. I see a lot of opportunity. I see a lot of opportunity where I see banks sitting with a lot of legacy. And I think we are there with the one more point that I have to make. What is the tailwind that I'm seeing? I see that the cloud technologies that we invested in, our architecture, our API first architecture, and our product being cloud ready, whether it's Azure, whether it is AWS, that is giving us the flip. And that is a competitive edge that we have today.
Arun, I have a small question on Microsoft. The tie-up with Microsoft, when do you see the results coming in terms of order flow coming in? And are we increasing the bandwidth to take care of the orders that can flow in?
Yeah, it will take 2 quarters, 2 to 3 quarters. I think by January, we can expect some order flow in from that deal 9 months from now. And we have time to take care of that. So that's why we need to plan next round. As soon as we reach $75 million, we need to plan for some additional capacity in 3rd quarter, 4th quarter to be added that time to make it $90 million. $15 million is a good bucket. Quarter on quarter we run. So we can. So that is working very well, Nishit. That this $15 million bucket size to increase the capacity, it's not too much, not too less.
That's all from my side. Thank you and all the best.
Thank you.
Thank you, Nishit Bhai. Next, we have Mr. Utkarsh Solapurwala from Damos Capital. Utkarsh, please ask your question.
I have 2 questions. First one is, what is the current status on AIF that we are looking to create on the investing in ecosystem?
We are still waiting for the approval. We have applied in SEBI. SEBI is taking time to asking some questions. So as soon as it's through, as a strategy, it's the same strategy. We are looking for those small ecosystem players to invest into for IDC marketplace. So that's a 23-24 agenda. So by that time, this should be completed.
Second question is, as we scale up from $60 million to $90 million and potentially $100 million in next 2-3 years, are we ready with the management bandwidth for the top leadership positions that we might need to create if as the revenue is inching higher?
We have a very high quality leadership capital. We have 50 partners in the company, very rich capital available, and close to 365 VP plus leaders with more than 25 years experience. So this is a highly rich expertise is required. So that's what I think we invested upfront, and that's what we are leveraging.
Thank you.
Thank you, Utkarsh. Thank you, Utkarsh. Now we have next question coming from Mr. Harshit Chetia from AUM Fund Advisors. Harshit, please ask your question.
Yeah, sir, I had a question on currently our deal pipeline is of around $725 million. So what is the timeline of the deals? Do we have more on the shorter end of the deals or more longer tenure deals, if you can give a picture?
Yeah, so this deal pipeline, we qualify Destiny deal. This Destiny deal, we are reporting separately in the deck on the slide. If you go to the slide, there is a Destiny deal slide where some of the decision of 61 deal, some 10 or 12 deals get decided in a quarter. We win 2 out of 3. We win the deal. One deal, typically the ratio is coming 70%, 65 to 70% win rate in those Destiny deals with us. So that's one forecast we can look at. And they are, as I mentioned, that we learned the art of having a larger deals like RBI $50 million deal. So now we have a capacity to get $1 million deal to $50 million deals. So obviously the quarterly impact comes from the major deals, while $1 million deals are also important for us to keep our cloud running over there.
Sir, actually my question was, on the same slide of it's, I guess page number 35, you mentioned that our funnel pipeline is of $625 million.
$725 million, $625 million is 167 opportunities.
Correct. So what is the timeline of the deal? So basically, is it, so majority of the deals are like 3-year deal, 5-year deal, if you can tell me.
There are two questions you are asking. You are asking duration of the deal when it closes, or size of the deal for which the deal will be.
Duration is my question.
Duration of the deal, once you sign it, it's a 10-year deal. Once you sign a deal with any customer, it's a 10-year deal. Nobody changes the license.
Okay. And secondly, I had this question with Microsoft. So, what products are we going to sell with Microsoft? Are we like working with Microsoft for our platforms, or how is it? Can you just elaborate?
Yeah, so we are working on all the GTB products, suite, cash, cloud, payments. They are exclusively signing with us, and for other products, they are working with us. So GTB products are exclusive, which I mentioned. Other products will be there. So that's a current arrangement.
Okay, thank you.
Thanks, Harshit. Next, we have Mr. Ankush Agarwal. Ankush, please ask your question.
Yeah. Hi, sir. Thank you for taking my question. Congrats on a great set of numbers. So firstly, Temenos in the recent capital markets, they have said that, going forward from 2022, they will stop selling licenses and subscription would be the standard offering for new and existing deals. So, wanted to know your thoughts on how does this impact the industry, if the market leader shifts to a permanent subscription-based model, and how does Intellect is looking towards this?
It's good news for us. If somebody says that he doesn't want to sell on-premise license and we are selling it and customer wants a on-premise, so it's a good news for us.
Okay, so but Intellect internally doesn't have any plan to move to a permanent subscription-based model.
Why should I do it? My customer focus is there. I want to look at it, what is right for the customer. If customer wants to invest upfront for the capital cost, I want to pay him capital cost. And if customer wants have a operating cost model, I would like to give him. So as a design thinking, I'm all about customer here. Customer is in the center and run around the customer.
Got
it. Why should I tell customer what he should be doing here? I cannot tell customer that you should wear blue shirt or a white shirt here. Let him wear whatever he wants to use.
Right. No, the question was such that, if the industry leader is moving to such a model, do you think the overall industry dynamics will shift more toward the subscription-based model, or you do think like it won't make that much of a difference from the industry perspective?
It's a customer here. Industry doesn't have anything. Customer drives the industry. What customer asks, we have to do it. And I think what your question is right, that if leader is moving towards, it's good for us, at least for, we also have a cloud revenue grown 112%. We are also finding, we would love to sign the cloud deal because cloud deal has a 10-year moat and you can grow the revenue year on year on the cloud. So we always want to sign the deal, but we never want to say customer that we only sell one thing, not sell other thing.
Got it. So something on the similar lines. So, our license revenue growth has quite tapered this year, right? Even though it's understandable that, the SaaS has grown like 100%. So, incrementally, a lot of deals are coming on SaaS, which doesn't have a license component. But from here onwards, how do you think? Do you expect the license will again start growing at double digit, or do you think that our funnel is such that, a larger part of our growth will be driven by the SaaS deals and such that, SaaS will already lead the growth and license would be more or less at the similar levels?
I think from an investor perspective, you should only understand license link deal. You track only one number, which is 57% of revenue is license linked deal. It's a means of winning the deal. Whether I win as a license or I win as a SaaS, it's a last choice given to customer. When customer selects a product, then his CFOs and his procurement department come into place, and they start saying, "Oh, give me this rate, give me that rate, give me this proposal, give me that proposal." We are quite flexible on giving those proposals, which is best suited for the customer without intellect.
That understandable. That you are more focused on the customer. The reason I was asking this question is, SaaS gives up business model more predictability. If Temenos, the entire thought process about them going permanently for subscription was the same. So I was just trying to understand if our deal, deal funnel is such that, a larger part of is SaaS, but got it that way. So lastly, for quite some time, we have been talking about this directional margin towards 30%, right? But given that some of the commentary that you made, that given that we have to enter 3 more countries and there we have to invest in additional R&D, plus on the sales front as well with the given Microsoft deal, you have to invest. So do you think that target is, like on the back burner for a couple of years now?
No, it's not a back burner. I think if $4 million deal comes in, then we would have 30 million this quarter itself. So focus is 30 million and we remain 30%. We don't want to go beyond 30%. Now 25, 27, 24, those are quarter to quarter game. Obviously for next 2-3 quarters, if we get some good wins, we may be able to come closer to 30%. Otherwise it may be 27, 26. So we are not so much hung up on the margin has to be 30%, but directionally we are in the same direction, and that's what our attempts are.
Right. Lastly, sir, just a little bit clarification on this Microsoft deal. You said the iGTB all products would be exclusive. So it would be exclusive on the Microsoft's end to sell this product, or our end that only Microsoft will sell this products?
No, not from our side. I think we'll go. Okay. We have a joint go-to-market plan with Microsoft. Microsoft has a banking finance team who has selected this product after a lot of evaluation.
Okay. So Microsoft on this area of products will sell only our products.
Yeah.
Right. And again, similarly on this, you said that this a guidance of 20% growth is there, but this Microsoft deal should add some tailwind. So this is over and above this 20% is what you're saying.
As of now, just keep it 20%. Yeah.
Okay.
That we have to just till the time.
Right. Thank you so much for answering this question. It was very helpful.
I want to clarify, it's not a guidance. We say we design the company for 20% because we can't give a guidance as a product company. We told 2 years back we don't give guidance, but that's why we never give 25% guidance or something. It happened, it happens.
Right. Thank you.
Thanks, Ankush. Next, we have Mr. Nandan Madiwala for Ankush's One Capital. Nandan?
Yeah, thanks for taking my question and congrats on the quarter. Just one quick question on the GEM platform. Till when is that deal going to go on? Because I remember somewhere around FY17 or 18 is when we won the deal. It was some 5-year or deal or so. So is it going to come up again for rebid, or if you can just clarify?
Yeah, so this deal is up to 24 basically. 23 December 23 is to be exact, and this is coming for 2 years. Extension is a part of the proposal, so we are looking forward that if it should be extended by another 2 years on that deal.
You mean beyond December 23, right?
Yeah, that's right.
Okay, thanks. That's it, and all the best.
Thank you, Nandan. Next, we have Mr. Amit Chandra from HDFC Securities. Mr. Amit Chandra. Please unmute him.
Yeah, hi. Am I audible, sir?
Yes, Amit. Yes. After a long time, I'm hearing your voice.
I know. Thanks for the opportunity. So my simple question is on the SaaS and subscription revenue. So like currently we are at 20% SaaS subscription, but how in terms of margins, how different it is, because typically SaaS and subscription is a high margin business. But as we are increasing our SaaS and subscription in our revenue mix, that is not being reflected in the EBITDA margins. So like one thing is that the non-SaaS non-SaaS revenue like margins are coming down. So is it, or is it the right way to look at it, or we will see the like benefit of increasing SaaS subscription on the margins going ahead?
Yeah, so Amit, the SaaS revenue in a full operating model in a stable operation is around 70%, which is rightly estimated that it should be around 70% on a fully operating model. But since we are in enterprise cloud, so if you look at this first statement we made, enterprise grade solution in the cloud. So what does it mean is that we will take a full client on cloud. They will pay us $2 million to $4 million per year on the cloud, depending upon what services is consuming. It may vary from $500,000 per year to $2 million. So it's different from a smaller cloud client like Freshworks, which will be signing for the $500 or $5,000 per client per year. So that's the difference, that we want to sign up a big enterprise. For that, initial investments are large. So when we are building up the entire business, we have to build up a higher capacity, higher investment, and this margin will come to 70%. So those contracts which will become into operating stage, they become into 60 to 70 to 80% levels. So that's the current level is there. So on margin level, this margin level of 23-25% level is not on annualized basis, 25% level, which is reasonably good. And I mentioned some deal like $3-4 million deal move here and there, left and right, that shifts the margin.
Okay, so this 70% rule or this 70% gross margin rule for a subscription revenue is, is it true for all contracts, or like there is a range which is very big in terms of margins that we engage with enterprises on the SaaS side?
I'm saying this is a full mature stage of here. GEM, we don't have that kind of a margin. Government of marketplace will not have that kind of a margin. That is much lower margin we operate at in government marketplace. But any global marketplace, those kind of market norms between 60 to 70% are established.
Okay, and sir, on the free cash flow conversion, what is our estimated or our target range where we want to operate in terms of the FCF to PAT conversion?
From EBITDA to cash conversion, last year we converted 322 crore on a EBITDA of 450 crore. So it's close to 70%, 75%.
Yeah.
So our target will be around 80% should be converted. 70% is a good number, but 80% should be our target.
Here also, Amit, if you see, if you compare over the last 6 quarters or so, you would see that it used to be in the range of 35-40%, and we've steadily been increasing that. So on an annualized basis, Arun just gave the figures, you're already at 70-75%. So maybe another 5% here and there is possible, but I think we're on the right trajectory there.
Okay. Okay, sir. Thanks and all the best for the future. Yeah.
Thank you.
Thanks, Amit. Arun, can we take a couple of more questions?
Just 2 questions. If you can take 6:10, 6:15, we can.
Okay. Thanks, Arun. Next, we have Mr. Ashish Kabra from Fair Deals. Please unmute him. Ashish?
Yes. Hello. Hello.
Yes.
So first, congratulations on a great set of numbers. So, sir, I just wanted to ask, like from a 3-year perspective, is this $100 million revenue? Is it? Yes. Is it? Can we make that, or that will go beyond 3 years?
Yeah. That's what we are working for. Yeah, not beyond 3 years. Not beyond 3 years. That we are working for 3 years. Yeah.
Okay. Thank you, sir.
There are a few questions here, Parveen. So Sanjeev Agarwal from Global Holdings, he pushed a question. Going forward, what is going to be the dividend policy? As of now, board is just evaluating what is the dividend policy. We'll be looking at based on 2-3 years of sustained cash flows and market scenarios. So we'll come back to you as soon as we define the policy over there. Somebody asked a question about the tax part. Tax part will be 26% plus 26-27% will be our overall tax number for the next year. But our effective tax rate or cash tax rate for which company will be paying will be at a MAT rate, because we have a MAT credit available to us. So our payout will be on MAT credit, and that will be 18% of the number. The third question is there are few lost deals. So Srinidhi Adiga, there are few lost deals from the pipeline. Could you please let us know what is the likely reason for those? Obviously 70% conversion of winning the ratio is always good. Yeah. You can't win all the deals which is there for you. So we all want to have all the IPL matches won by the one team, but there are other teams also to play. So which is the products will reach monetization phase? I think we have IDC as a IDC payments, iCredit 360, wealth and underwriting. All the 5 products are in the race for monetization 23-24. He is asking the question in 23-24. Something out of 5, 3 should go. 3 should be doing well in 23-24. What is the impact of losing Russian banking deal? There is no impact. We have not booked any revenue, so there is no impact at all. It was about to be signed. We didn't sign. If we would have signed, maybe we would have a positive impact, but no negative impact on this deal. There was Amit Kasat on saying GEM revenue of 1 lakh crore, it can move to 1.5 lakh crore. A lot of things are happening in government because there are some discounts in discounting is also available for the GEM. So based on that, predicting revenue of GEM is not 100% there. Ravi Mehta, Deep Financial, was it conscious step to let go of the Russian deal, or we can relook at that opportunity? No, it's not about letting go. It's just a situation that reached that point of dead bank opportunity in Europe, because no Russian bank will allow to open a branch in Europe. As of now, sanctions are there, so it will not be there. Okay, so Parveen, any other question? This is a question which came to my.
Thanks, Arun. One last question, we can take it from Mr. Gaurav Singh from Sarat Capital. Gaurav, you're there?
Yeah, I'm there.
Please,
so thank you for the opportunity, sir. So since you mentioned that you want to not push the margin lever too much, and you also mentioned that you're working on methods to reduce the implementation time cycles. So if you're not increasing the margins or not making a conscious effort to increase the margin, shouldn't that not be compensated in a higher revenue growth? So on the revenue side, you're saying you want to go calibrated, while you're also saying that you don't want to push the margin too much. So isn't that contradictory in a sense?
I'm saying margin is an outcome. Margin is not a driver. If we have a lower cost of implementation, margin will naturally grow. But we don't run the business for the margin. That's what I wanted to convey. So the meaning is different. Meaning is not that we don't want a margin. Meaning is that whether we focus on margin and that we take a deal, that's not the whole question around it.
Right, because there's a marketing cost side angle as well to margin. So you could hike your marketing cost, reduce your margin, and grow your revenue, right? So it should translate to a higher revenue growth, right? Yeah.
That's right. That's right. So this year, instead of 20%, we did 25% revenue growth. So it happens in a product business that sometimes when we are focusing on deal for 2 months or 3 months and we win the deal like RBI, it's a big plus. And most of the RBI accruals have not happened in the last, so that those will flow into the next year. Most of the revenue will flow into the next year. So these are the few positive sides of this trajectory. That's why committing anything over 30% is our baseline. I'm saying we design the company for 30% EBITDA, 20% revenue growth. That's the design parameters.
Right.
It can become 25%, 33%. It happened this year. It happened 33% and 25%. which is better than what we designed the company for. So whatever the guidance we given to board approval we have taken for the investment, still based on those investment, we could able to generate 25% growth.
Right. But since you want to, you calibrated it for 30% EBITDA growth. If you want to do that growth, and 20% is revenue, you have to grow your margins, right?
That's right. That's right. That's what we are looking for. But I don't want to commit I don't want to put myself in a box saying everything is committed. This number is committed. This number is committed. Then there's no management flexibility available here.
Sure,
we need to play the ball here.
Sure. Thank you so much for answering my question.
Yeah.
Thanks, Gaurav. So now we are closing the call. In case you have any further question or want to have a follow-up call, please do write to us or call us for the detail given on our website. Thank you for joining us today. Thank you, the management team, Arun, Prabal,
Thank you for the deep question. Yeah.
Thank you. Thank you, everybody.